This is the favorite chapter in my book right here. Oh, I can't wait to share this one with you. It's called The Perfect Retirement Plan. Oh, man, this is exciting. So this one's going to be good. Let's dive right into it. Oh, before I do, welcome to Heritage Wealth Planning, my friends, the place you come to learn about my book, The Tax Bomb in Your Retirement Accounts, and how the Roth IRA can help you avoid it. Just go to Amazon.com, type in Josh Scanlon, and until today's August 17th, until Monday, August 20th, I think, it is free on Kindle. It's always free on Kindle Unlimited, at least as far as I can tell. So if you don't have a Kindle Unlimited account, you can get this puppy free of charge on Kindle, regular Kindle right now. After that, it's only $4.49. It's well worth $4.49. If you don't save $4.49 in taxes, well, I'm not going to guarantee it, but I would be stunned. So $4.49, and then if you want the paperback, $5.99. Man, get the book. It's just fantastic. Especially once you watch this episode, you're going to want to. So don't forget to subscribe. Subscribe down below, my friends, because once you subscribe, you're going to get inundated with the content that we do. I say inundated facetiously, but we do 2 or 3 videos a day here because there's just so much to talk about financial planning. And unfortunately, there's a few good guys and ladies out there doing good stuff. A lot are not. And so this gives me the chance to say what's on my mind, and hopefully it'll benefit you as well. All right. Now, this is the perfect retirement plan, chapter 7 of my book, and I love this. And what I do is I read this a little bit to you, then I'll give you some commentary as well. But all right, with a Roth IRA or Roth 401k, you determine when you want to pay tax. All right, you do. That is a benefit of the Roth that I think is overlooked a lot. All right, so remember, anything contributed to a Roth is with after-tax money. If you choose the Roth, you pay tax now. If you choose the traditional IRA or the traditional 401k, you don't pay tax now. You pay tax later. And that's where I think the appeal is a lot with these traditional accounts. People say, oh, I can pay tax later. Why would I pay tax now? Wrong answer. But either way, it's up to you when you want to pay the tax. You get to choose if you want to pay now or later. You're going to pay some tax. Don't get me wrong. You're going to pay some tax. You can also convert, and a lot of people don't understand this. You can convert all or a portion of your traditional IRA, 401k, 403b, or TSP. You don't have to do it all or nothing. You can convert all or a portion of it in any given year. But just remember, when you do make that conversion, it will be taxable as ordinary income in the year you did it. So for instance, if you were to convert $50,000 of your traditional IRA to a Roth, that $50,000 will be taxed as ordinary income, OI, in the year in which you did it. So you don't want to do that in a high tax year. You'd rather wait until your taxes are low before you do that. Now hang with me because we're going to get into that because that is a wonderful way to use the strategy. But again, when you do make that conversion, you choose when. Now, we're going to play out a scenario. We're going to bring in Sarah and Dan. They're our sample retirees, and I'm going to show them the perfect retirement plan. So Sarah was a marketing executive making, she's making $150 a year in salary, but she also got a $50,000 annual bonus. Dan was also making the good money as a sales consultant. He's making $75,000 a year. So between them, they had $275,000 of gross income. Sarah's $150, Dan's $75, and then $50,000 of Sarah's bonus. Now, because their kids were no longer at home and the mortgage was paid off, the only deductions they had were the deferring as much income to their 401k plans as possible. And last year, they're both able to do the maximum of $22,000. So when we have our earned income of $225,000 plus the bonus, that means our gross income is $275,000. Their 401k deferrals is $44,000. That comes off the top. Their standard deduction is $24,000, which means their taxable income in this case was $207,000. Now, if you go to the next page, their taxes. And see, this is how taxes work. It's important to understand this. So they pay 10% on the first 19, and I'm not going to read it all verbatim, but this is how the marginal rates work. So they still only pay 10% on the first 19,000, 12% on the next 58,000, 22% on the next 87,000, so on and so on. So their total tax bill on $207,000 of taxable income or $275,000 of gross income is $38,259, an effective tax rate of right about 14%. That's not too bad. I mean, $275,000 of gross income, and they're only paying a little bit less than $40,000. Not too shabby. But let's watch when they do the 401k into the Roth as opposed into the traditional IRA, a traditional 401k. 225,000 of earned income, 50,000 bonus for Sarah. They still got 275 of gross, but notice they do not have a line item for 401k deductions. So the only deduction they get is 24,000 for the standard deduction, which means their taxable income is 251,000, and that's going to raise their taxes quite a bit from 38,000 to 48,000. It's going to raise them by 33% at $10,000, and because they don't have that 44,000 of deductions because of the traditional 401k. And now they go from an effective 14% tax bracket to 18% tax bracket, and they're paying almost 50,000 income tax, whereas before they're paying almost 40,000. But remember, there's a huge difference between deferring income, a la 401k deferrals, and negating income, a la standard deductions. Deferring income simply means you don't pay tax on the income today, but you will at some point. And this is what I want to point out. Ages 62 to 70 are the golden years of tax planning, the golden years of tax planning. So we fast forward a few years and see that both Sarah and Dan have retired. Sarah is 62, Dan is 66. They were not taking Social Security yet, just living off the savings they were able to squirrel away. They don't have any mortgage. They figure they spend about $50,000 a year on everything. That's in vacations, bills, helping the kids out occasionally, et cetera, et cetera. Now, they come to my office. They say, Josh, should we take our Social Security now? They've accumulated $300,000 in their 401ks, and they also have $150,000 in savings that are sitting in savings and checking accounts and short-term CDs at the bank. And so they say, we think we should take our Social Security to allow our 401ks to continue to grow. No, absolutely not. Do not do that. Given they have no income other than the minimal amount of interest they're receiving on the bank, and we're talking, $150,000 at 1% is $1,500 a year taxable interest. That's nothing if they even get 1%. They have no tax. They're literally paying no tax, and they will continue to pay no tax until they reach the age of 75 when RMDs kick in. What they should do is take advantage of that tax, that zero tax, and start moving money over to a Roth now. Any income they receive up to $25,300 is tax-free. How did I get $25,300? Because Sarah is 62 and Dan's 66. Sarah's standard deduction, being under 65, is $12,000. Dan's standard deduction is $13,300 because he's over 65 years old. I cannot stress this enough. They have $25,300 of tax-free income coming their way just because they're standard deductions. So when your tax rates are low, convert to Roth IRAs. Please, for the life of me, if your tax rates are low and you have money in traditional IRAs, start converting money now. Take advantage of your low, in this case, zero tax rates. So they're in my office, and let's say I'm able to convince them to convert $50,000. That $50,000 again will be taxable as ordinary income. Yes, it will. No getting around that. But with the $25,300 of standard deductions kicking in, and the fact they have no other income other than a tiny little bit in their interest that they're getting off the bank, all their taxable income will be all of $24,700, which means they'll only pay $2,583 in taxes. That's it. $2,583. That is a small price to pay for the benefit of that $50,000 being tax-free forever, ever. Heck, I'd even advocate that they convert a whole 100,000. A 100,000 conversion will raise their total tax to $8,655. But again, that $100,000 will never be taxed again. It will never be taxed while Dan is alive. It will never be taxed while Sarah is alive. It will never be taxed when the kids inherit it, should the kids inherit it. And I'm going to show you why they will here in a second. All right. Now, here's a beautiful retirement plan. Let's say they convert remember, they started with $350,000, so they convert $100,000 each year. Okay, so $100,000 year one, $100,000 year two, and the rest in year three. Now they'll move all their money from their to-be tax accounts to their never taxed again accounts. And in year four, they'll have exhausted all of their cash savings. Because remember, they got to live off something. So they have $150,000 in cash. Their expenses are $50,000. So $50,000 in year one, $50,000 in year two, $50,000 in year three. They convert $100,000 in year one, $100,000 in year two, and the rest in year three. So in year four, they have nothing in traditional 401k or IRA, and they have no cash left at all because they spent it all on those 3 years. where they basically had very minimal income for sure. All right. So now what they do is they go and they file Social Security. Now, Dan at this stage is 69 years old, which means he'll have a major benefit bump off his primary insurance amount because taking advantage of the delayed earnings credits. So I don't get a lot into Social Security on this book in terms of how delayed earnings credits, PIA and FRA and all that. I don't get into it a lot. But as you know, if you're watching the YouTube channel, I got tons of stuff on Social Security. But just remember, we're going to give you a brief on how this works. If Dan averaged $75,000 a year over his earnings career, his average index monthly earnings will be $6,250. Now, I just want to take a time out and remind you how this works. Social Security will take your top 35 years of earnings. They inflate those, and then they divide that number. They add them all up, and then they divide that number by 420. That is your average index monthly earnings. So in this case, I'm saying Dan averaged $75,000 adjusted for inflation each and every year for those top 35 years. You had $75,000. In this case, you add it 35 times and divide by 420, you'll get $6,250 as your AIME. But that's not the amount you get on Social Security. Remember, you got to do the little convoluted calculation that Social Security has to get your primary insurance amount. And your primary insurance amount, your PIA is the amount you'll get at your full retirement age. In this case, it's 66 for Dan. So his PIA will be $2,519 off of his AIME of $6,250. So if you average $75,000 a year, every year for those 35 years, your PIA will be $2,519 when you are at your full retirement age, which is 66. We know that. That's all there is to it. But he waited for 3 more years to take his Social Security, so he got those 8% a year bumps on his delayed earning credit, which means his benefit will now be $3,173. $3,173. Not too shabby. Now, Sarah, on the other hand, remember, she's 4 years younger than Dan. So during those 3 years, she's 62, 63, 64. Now she's 65. Now, she made the maximum for her benefit, her income for Social Security. So her PIA would be about $2,800 a month. But remember, the PIA is the amount you get at your full retirement age. And again, 66 is for Sarah. But because she's taken at 65, that will be reduced by about 7% or so. So she'll get $2,600 a month roughly because she's taken it reduced. Dan will get $3,173 a month because he's getting more because delayed earnings credits. So we take our trusty calculator, $2,600 a month plus $3,173. That means they're both going to get between $5,773 in Social Security, which is almost $70,000 a year of Social Security. $70,000 a year in Social Security, no tax because Social Security is tax-free if that's your sole source of income. All right? What is their income needs? $50,000. All their income needs are met by Social Security. All that will be tax-free. Now, let's just say later on at some point they need to dip into the Roth to augment some of their income. I don't know, maybe they're going on a beach vacation. Maybe they're helping out a kid with college. I don't know. Well, guess what? They pull the money out of the Roth and they pay no tax, none. Social Security is still tax-free. Roth IRA distributions are tax-free. We're talking no tax. Now, think about this. Sarah and Dan's was 69, Sarah is 65. There's a good chance they're going to live another 25, maybe 30 years. If all their money, income needs are off Social Security, on occasion they pull money out of the Roth to augment that. They're never, ever going to pay tax again, at least income tax, ever. Ever. Think about that. And they're going to live off a significant amount of money. Can that happen to you? Absolutely. Absolutely can, if you plan correctly. So remember, Roth IRA plus Social Security is an amazing benefit of the tax code. If you can get it situated where the bulk of your money comes from those two things, my friends, you win the lottery. You win the internet. You win the tax code. And you should be congratulated. Unfortunately, most people don't do that. They say, I'm going to kick the can down the road, and then all of a sudden I walk into that tax trap. It's bad. All right. Well, exactly, because we've been taught to defer. And that's what I wrote my book to try to teach people not to do. Don't defer. Pay a little bit more today to pay a whole lot less in the future. Remember, Not only will all their income be tax-free, they will not increase their Medicare premiums. It will not increase their qualified dividends and capital gains, should they have any. Their Social Security will remain tax-free. It's just the way to go. All right, my friends. Well, if you like what you see here, subscribe. Hit the bell to be notified. Thumbs up. I'm telling you, thumbs up help a lot. So thumbs up always help because YouTube, the algorithm says, people actually like this guy, Josh. If people like him and they're watching his YouTube videos, let's show other people on YouTube. That will mean more people will watch my YouTube channel, which makes YouTube very happy with me, which means they'll show it to more people. It's amazing how that works. So thumbs up, please. Comments below. Always love comments. Go to heritagewealthplanning.com. heritagewealthplanning.com is the blog. You can see the podcasts I do. You can see all the blog posts I have, everything on there on heritagewealthplanning.com. So we'll see you next time. Thanks, guys.